Hello and welcome to the Money Show, your one-stop destination for all your personal finance queries. I'm Kavita Thapliyal, and today once again we'll be focusing on your financial portfolio and a very interesting discussion on how can you continue investing even when the markets are volatile, and especially where in a week we are seeing more than 2 days where the market is not doing well. In fact, it's on a downturn, and then the investors want to do a lump sum investment or may want to do an SIP investment. What does the history tell us, when an investor in such a volatile market try investing? What's the kind of return in the long term that they have gained, and what should be your strategy going ahead? We'll be discussing this today on the show, and we will also go upon your the counter to get your mutual fund portfolio queries answered. Just in case you want to send across your questions, you can do that on our WhatsApp number, which is 865-797-4571. We also have an email ID, which is themoneyshow@etnow.tv. So let's begin the show, and today on the show I have with me Shweta Rajani, Head Mutual Funds, Anand, Rathi, Wealth. Shweta, hi, good evening and welcome to the show. So Shweta, investing or not investing when the markets are volatile is more of a behavioral aspect of your investment journey. If you're a long-term investor and if you have a goal-oriented or a goal-based portfolio, you will know that you want to keep investing in a very disciplined manner, which means participating at all market levels. The market is high or it is down, you are participating and putting in money and acquiring as many units as you can. But let's talk about the fear angle, where which actually grips the investor and they lose out on their night's sleep because of that. Even the long-term investors, even if your portfolio is goal-aligned. Shweta.
Hi, Kavita. You're absolutely right. The best approach for creating money over a longer time period is to have a discipline in your investment pattern and not get influenced by short-term market behavior. But yes, at times it does tend to happen that when we are seeing a phase of correction, which is what we are witnessing right now, because if you look at the market, mid-September was when we saw a peak of 26,200 odd levels. And after that, markets have been pretty much volatile. And in fact, if I see from there till yesterday, markets have seen a 12% odd correction. So it's but natural that fear seeps in and investors get influenced by this short-term behavior. But, let me draw attention to one data point. And this is an analysis that we've done that any investor who followed a disciplined approach and invested every month in equity without being bothered about, what the market level was, the average return that such an investor would have experienced would still be around 12% per annum if you stayed invested for 5-10 year period. So one has to remember that equity investing is for long term. One should not get influenced by short-term market behavior. Short-term markets react to news and events, but over a longer time period, fundamentals play out. And to get the benefit of that, one has to stick to the approach of staying invested in equity for a longer time period and not timing the market over shorter periods.
Shweta, now let's explain all of this to our viewers with some data, okay? In last 25 years, how many times has the equity market given negative returns? If you could just count on those years.
Absolutely. And we've done this study as well. If I just look at just annual returns, okay? So if I can count it on my fingers, it would be 5 years, right? And I'm talking about financial years here. There'd be 5 financial years where market would have given negative returns. So out of 25, if you're just talking about five, that's clearly a very low probability of it's equity is not as risky as it's perceived to be. And anyone who would have stayed invested in equity for longer time periods, and this was another study done which shows that from 2001, if you look at different investor experiences, any investor who stayed invested in equity for more than 5 years, there's a 98% probability that they would make positive returns in equity. And I'm talking about the index, and I'm not talking about the active funds, because if you talk about active funds, then this would go, I'm guessing to a 99 or closer to 100% probability of making positive returns in equity. So this again suggests that don't be bothered about the short-term corrections in market.
So Shweta, the data that you're presenting also, so you've looked at the maximum fall. Now FY21 minus 10.5%, FY22 it's minus 14.15%, FY23 is 15.2%, FY24 6.6, and FY25 is minus 12%. And historic returns in these years, 2021 has been 70% that we are talking about. 21, 22, 18%. 2023 was a very dull period for the market maybe, but 23, 24, 28% again, and 24, 25 so far 10%. So yeah, we have seen a negative downtrend also because of the volatility in the market, but then look at the returns that a long-term investor who was stable in the market, who was disciplined in their investing must have gained. Now, see, volatility can also be your friend, Shweta, if you strategize it very well and if you also rebalance your portfolio very well, and that is what we've been saying since the beginning of this year, that do not expect the kind of returns that you saw in 24. Maybe 2025 is the return where you need to taper down your expectations and maybe have that revamping and rebalancing in your portfolio. And not that the volatility will definitely have a negative impact, but if you reshuffle and revamp your portfolio and maybe just diversify across asset classes properly, you might see the continuity of the previous return in your portfolio. Shweta.
Absolutely. So two things here. The first data point that you said, see, over a longer time period, equities have delivered 11-12% return, but every year there would be that one phase where market's going through a correction. So, peak of that year to the trough of that year on an average, if you look at the last 20 years, the average correction that market would have seen has been 18% per annum. So this could be a year where market point to point still delivered good returns, but there was that one phase of market during that year where it corrected. On an average, just to give few more numbers over here, on an average it's taken 3 months for the fall, and after the fall it's shown that within 7 to 8 months markets rebound and continue that upward trajectory. So yes, volatility is your friend. Anytime I would say one sees a correction of more than 10% from the peak that year, please use that as an opportunity to build your portfolio. While you may be following a disciplined approach, when you see such phases of correction, if there's any money that has to go into equity, I'd say you can go all in there. That also gets me to the second point, which you highlighted, Kavita, on rebalancing of the portfolio. Rebalancing of the portfolio should be done at regular frequencies because when markets go through these cycles, when they go through these corrections, it also leads to some segments becoming very attractive, valuations correcting themselves, market cycles turning towards certain sectors that could again become favorable. So yes, there should be an annual review rebalance frequency which one should set on their portfolio. See what's done well for you, see what's expected to do well as per the market conditions, and see if you're positioning your portfolio to get the benefit of the changing environment over here. And that gets me to one more data point. Sorry, I'm flooding you with a lot of data points here, but over the last 20 years, if you see the difference between the best and the worst performing schemes being roughly 18% per annum, which also highlights that everything goes to cyclicality. And, when market gives you an opportunity, please do revamp or rebalance your portfolio.
Sure. One more thing, can we also figure out some data, or data is actually the best way an investor can really understand, okay? So talking about data once again, any specific category that you want to highlight which has been like a rock star category, across time phases in the market?
So, see, if you talk about, I was just saying some time back that there's cyclicality that plays out, and the recent behavior, if I see over the last 2-3 years, small caps followed by mid caps have been all top, on top charts over there. If I leave aside, post 2021 phase where mid small cap rocked and categories, therefore, mid, small, or multi were topping the charts. Prior to that, you had a phase where it was clearly the flexi caps or your large and mid cap. Large was doing better than the so-called multi, mid, small. So that was the phase of so almost second half of 2018-19 that did well. So there'll be not one such category that would have done well throughout. And that is where you should relook at your mutual fund portfolios once every 6 months, once every year to see what you need to change. But I think if somebody wants to, stay invested for longer time period, you can be in categories where something like a flexi cap or a multi cap, where all through you'll get benefit of these different market caps in your portfolio.
All right, Shweta, I think we will again get back to this topic with our viewer queries also, because then we'll be having our viewers online, and there are very different scenarios where you might have to just repeat the same kind of explanation for our viewers. But then let's take a quick break and let's connect with our viewers online. And just in case you want to send across your questions even now, you can do that on our WhatsApp number and email ID. So see you after this break.